Welcome to the latest Evershed Sutherland Legal Insights podcast.
Hello and welcome to Taxing Lyrical, the Evershed Sutherland podcast providing topical conversations for curious tax professionals. My name's Rebekka Sandwell and I'm a professional support lawyer in the London tax team at Evershed Sutherland. I'm joined today by Paul Beausang and Charlotte Stodell from Evershed Sutherland's London office. Paul is our head of real estate tax and Charlie is also a partner in our real estate tax team. You may remember Paul and Charlie from our recent podcast in which they discussed their predictions for the recent autumn budget. In this podcast, we're going to revisit those pre-budget predictions as a jumping off point for discussing the actual budget announcements and the impact they may have on our clients. Many thanks, Paul and Charlie, for joining me on the podcast today. So let's dive in and revisit your predictions for the budget, which you considered were very likely. Charlie, you anticipated that the non-resident SDLT surcharge would be increased from 2% to 3%. Please, could you talk us through the actual SDLT announcements in the budget?
Yes, happy to. And I'm, in a way, very disappointed that my very likely prediction was the first thing I failed at. They did not increase the non-resident surcharge, so that remained at 2%. But Paul is making that, noise, because what they did do is increase the surcharge on second homes from the 31st of October. So now the SDLT surcharge that applies to acquisitions of additional dwellings by individuals and companies is increased from 3% to 5% across each tier, across each threshold. So that's a big uplift and will, although not specifically directed at non-residents, will it equally apply to them to the extent that they own more than one UK property. So that was a little bit of a surprise coming out. So in the very likely category, we wouldn't have put that one. What they also did was increase the flat rate of SDLT that applies to acquisitions of high value residential properties. So that's anything valued at over 500,000 by companies or partnerships or collective investment schemes. So that's increasing from 15% to 17%. And what this broadly means from an SDLT perspective is that instead of the highest rate for residential being 17, which was already high, it is now 19% that could impact on acquisitions. And I think the biggest surprise about this is potentially how it's going to affect the market, especially in the private landlord sector, where we will see people seeking to exit the market and having a reluctance perhaps to come in. Of course, that's subject to release and things, I think the important one to mention on this podcast is probably if you're still going to benefit from the 6 or more dwellings rule, where you can still apply the commercial rates, these increases don't impact, but not everyone will benefit from that depending on the transactions. Important to just mention that this applies, I think, as I said, from the 31st of October 2024. There's the similar grandfathering rules that have applied to SDLT on the past. So you just need to look at when the contracts were entered into. If that was pre-31 October, then provided you don't vary or amend, then you will still benefit from the rates previously. But it's just a case of looking at your contract dates and working out what applies.
Okay, great. Thanks, Charlie. So, Paul, you predicted that the budget would include various capital gains tax changes, including carried interest being taxed as income, the income tax and CGT rates becoming more closely aligned, and potentially rebasing on death being removed. You also discussed the possibility of anti-forestalling measures being introduced, which could apply post-budget CGT rates to unconditional contracts exchanged pre-budget. How did the actual budget announcements compare with those predictions?
Yeah, I'm probably going to give myself a C- for that, in that, parts of it were good, but could definitely have done better. So Mystic Meg's under no immediate threat at this point in time. So on the carried interest, I think my colleagues, Ben Shemtall and Richard Surtees, have already done much more scholarly and interesting stuff on this. So I'm not going to dwell on that, other than to note they've certainly moved closer to the income tax rates, and there seem to be proposals to tax some of the carried interest as income rather than gains. So there's been a movement, but certainly not full alignment in that direction. In terms of the CGT rates, that has moved, and it has moved upwards. So I think what would have been the basic 10% rate has moved to 18%. The higher rate of 20 has moved to 24. Charlie has already explained the pain and suffering they visited on purchases of residential assets on the SDLT end, so they've not further increased that. I suppose you could be grateful for small mercies. It would be one approach to that. The more cynical part of me might think that this is more of a Laffer curve effect, in that they've decided the most money they can possibly get out of people is by leaving the rates at these sorts of levels. There's certainly a lot of historical data suggesting if you put the CGT rate up to 45% or 40%, what you'll actually see is people deferring disposals. And again, on the sort of what might happen on death and potential sort of blended tax rates of 67%, that they've not done that with the rebasing. So the good news for everyone is there still is rebasing of assets on death. But as I said, my right answer for the wrong reasons bit might come in with what they've done on pensions. So I won't overly dwell on this stage, but there is now a horrible cascade whereby you could have somebody who's had basic rate pension relief throughout their life of saving, but nonetheless, if they've done it successfully and well, they end up getting, or their estate ends up getting taxed at 45% income tax, so higher than they've ever had relief at when they withdraw it, coupled with IHT on what's left, which will produce a marginal rate of tax of 67%. Now that's clearly going to impact on behaviour.
Okay, thanks, Paul. Let's now move on to those predictions which you considered were less likely. Charlie, you thought the budget might include the introduction of the reserved investor fund. I assume you were pleased to see that the budget included an announcement in this area?
Yes, well, I would give myself an A star for this one, which is always, compared with Paul's C minus, I think I'm doing well for this particular prediction. But yes, Treasury confirmed it's proceeding with the introduction of the RIF. And it's also going to make some minor changes to the co-ownership authorised contractual schemes, or COACs. As I said before, I think the RIF is intended to be a new UK contractual scheme open to professional and institutional investors, but not the broader retail investment market. I think what's exciting is that what we're going to see is legislation brought forward before the end of the tax year 2024-25, or we hope we will. But it remains to be seen when this is actually going to be put into effect. But anyway, it was a positive prediction that came true.
Great. Yeah, nice to have one of those. Paul, you thought the budget would include pensions tax changes, and you suggested that these changes may consist of employer national insurance contributions being added to employer pension contributions, or pensions tax relief being restricted, perhaps to the basic rate of income tax. Mm-hmm. What are your thoughts on the actual pensions tax changes in the budget?
So again, I can't possibly match Charlie's A star. I'll give myself a bit better, maybe a B minus this time. They've effectively tried to raise the revenue, but using slightly different metrics. So I had looked at employer national insurance being added to the employer pension contributions. Interestingly enough, that was clearly debated. There was an IFS statement on it. And what came back was, because of the final salary arrangements with the public sector, it was clear actually the weight of those national insurance would probably fall on public sector employees. That in turn would upset the pay deals they've literally just settled. So I think that was more of a political expediency for why that one disappeared. All they did was effectively back solve and work out how much they needed to raise as direct employer NICs. So not tied to pension contributions, just direct employer NICs rises. And the interesting thing, given the declared aim was not to tax working people, they both put what's essentially a flat rate tax on employees indirectly up to 15%. So the employer's national insurance contributions are now 15%, but they've also rebased where it starts. So not only have they frozen thresholds, they've now reduced the threshold down to £5,000, I think from 9,100 or 200. So the point is, there's a lot more national insurance paid on employment. It's hard to reconcile how significant additional tax on employment isn't a tax on working people. It's also worth noting quantum. So if you look at the book of estimates, this change is slated to raise 25 of the 40 billion. So we spent a lot of time talking about the other changes. Actually, most of them, things like that on school fees in particular, are essentially window dressing and political statements. It's these changes which are actually the real revenue raisers.
Mm. And which actually impact working people.
Correct.
Indirectly, at least.
Okay, finally, let's move on to your wildcard predictions. Charlie, you mentioned the possibility of SDLT being imposed on purchases of property-rich companies and the possibility of a wealth tax being introduced, potentially through an annual tax being imposed on assets above a certain threshold or through amending an existing system, for example, rebanding council tax bands. I assume you were relieved that those changes didn't materialise in the budget?
Yes, relieved, but also not that surprised because they were quite out there in terms of being predictions. I think one thing I did want to mention, because the SDLT on the purchases of the property-rich companies, I think that would have severely impacted the real estate market, and it's sensible the government didn't bring that in, and that's good to see. And it was good to see them not overtly go after anything like a wealth tax, because again, the backlash would have been perhaps worse than the Chancellor's already facing. But I think one key thing that hit me was the positive spin on things that actually stealthily do increase tax. Again, the commitment to freeze the tax bands up until 2028, that could have been reversed, but it's kept in there. And I know Paul's going to tell me that's because it's in the estimates that she inherited, but in a way, although they didn't hit that, we still don't know what they're going to do with the council tax bands. It's possible we could see changes there, I suppose, but we'll have to wait and see. But yes, relieved, some good news.
Okay, thanks, Charlie. Paul, you had several wildcard predictions. You mentioned the reform of business rates, the possibility of treating companies owned directly by individuals which own residential property as tax transparent, and the possibility of a digital nomad scheme to replace the non-dom scheme. What are your thoughts on the budget announcements in light of these predictions?
Like Charlie, these were all just a mix of things I thought would have been sort of thematically consistent with what she's doing and interesting ways of doing it, rather than things I particularly thought were likely to come out. I mean, the business rates is very interesting in that, and as Charlie's already sort of averred to, a very strong sort of theme of this budget is to raise revenue, but with the least amount of visibility possible. So a single rise, but on employers, so not on individuals, of NICs, freezing rate bands. And it very much, again, with business rates, the various reliefs we had for hospitality sector, retail, are simply going to be allowed to expire. So it's not that they're raising taxes, they're just taking limited time sunset clause reliefs and letting them expire. And that's very much what's happening. So the real world effect, of course, is we will see business rates for the hospitality sector and retail increase as some of the sort of COVID era reliefs expire and aren't renewed. It doesn't mean the fundamental disjunct between IT companies and what tax we raise from them versus tax on people who physically occupy property like retailers and wholesale has been fixed. That issue is still there. It's endemic in the tax system. We've not addressed it. Treating companies, I think what was one of the suggestions, making companies look through, so piercing the corporate veil for tax. They've not done it. I wouldn't rule it out in the next 3 or 4 years. I think she said this is the major tax raising things, but if you look, the interesting thing I did see, and obviously Charlie's already made the point that the individual buy-to-let sector is in strong retreat. However, if you delve into the data, what activity there is, there's been a 30 to 40% rise in people buying with buy-to-let corporate mortgages. So even in a market where the overall market is shrinking, the number of corporate buy-to-let mortgages is increasing. That's a natural factor of a 25% tax rate and full interest deductibility. But again, a tweak to the system that they could use in the future is definitely to make that look through, which would essentially remove all of those benefits. The digital nomad scheme to replace the non-dom abolition was more wild optimism than wildcard. I think it would be a very good idea. You look at international competitiveness, and you look at what's happening as we record this podcast. We've just discovered Donald Trump has been re-elected, and I'll try and avoid saying anything overtly political at this point. But one of the things we know is that he's already said Elon Musk is going to be appointed to cut 2 trillion out of 6.5 trillion out of the annual government spending. So it's very clear that other countries are looking at reducing their tax takes and what they're going to end up trying to take out as part, I imagine, of what's a global competitiveness push to try and capture this entrepreneurial mobile talent. It's disappointing in an era where the avowed aim was to create an investment culture in the UK that we haven't created anything for internationally mobile entrepreneurs. And again, I think that's going to hurt us in the medium term unless we do address something there.
Okay, so we'll watch this space. Before we end the podcast, are there any other points that either of you would like to make about the developments in the autumn budget and the impact that they may have on our clients?
The one thing I'd like to say is I think the mood is definitely very muted. And I think one point I would make is I think the government hasn't done a very good job of emphasising any positivity. Although they talk about growth, it's difficult to see at the moment how that's going to come about as a result of what they've done, which I don't think is, helpful.
I'd strongly echo that. So yes, we've talked about essentially how they're going to raise 40 billion in tax. What we've not talked about is they've committed spending aims of 70 billion, 30 billion of which we borrowed and categorised as structural debt. We should be talking about it because a large chunk of that's meant to address things like social housing, affordable housing, kickstarting programs, catalysing new developments. There's been very little news, been very little reporting. We were promised a lot of stuff. We don't see that activity. I think if you're bringing out a budget this harsh, this amount of tax raising, it would have been an excellent idea to explain to people where the growth is going to come from to replace it. Because ultimately her proposition is that whilst taxes will rise now and have to, ultimately it's growth that will save the economy. It's growth and tax on the growing economy that will ultimately fund all these changes. It would be much better, I think, to have seen a much bigger play rate of that growth.
Would you say, though, that it's at least positive that, for example, with the corporate tax roadmap, the government has committed to keeping the main rate of corporation tax at 25% for the duration of Parliament? So at least there's some positivity around stability there?
No.
Okay.
I think I can see how that is. I mean, it could be worse, but I think I agree with Paul that actually making something of how this money is going to be employed and the reasons it will make life better would have been a very easy win that was simply overlooked, or seemed to be.
I think anybody who assumes you could make a strength or virtue out of the UK's consistent approach to corporate taxation is possibly borderline delusional.
Not you, though.
We have gone from a system where we funded cutting corporation tax rates from an excess of 30% down to 18% by essentially massively restricting capital allowances and deductions for that, because we thought that would fuel employment. We have pivoted almost immediately to full expensing, which is completely thematically the opposite approach from a taxation point of view. If you were looking at a large capex investment into the UK, unless you could be certain you could deploy the cash very quickly within a very short time horizon, that would be quite a courageous step in my view. And I also don't think the people who are making these sorts of investments will believe a government statement like that. They will only, if you look at places like Ireland's had a corporation tax rate of 10 to 12.5% for 40 years. It's not because Ireland says it will, it's because it's a track record it can point to. I think what will be much more important to Rachel Reeves and to the government as a whole is if they can demonstrate consistency, if they can demonstrate we won't tinker with this, if they can avoid doing things like corporate interest restriction, where you nominally keep your tax rate at 25%, but you drive your effective tax rate, which all the big corporates are smart enough to work out, to excessive 25%. If she can manage all that, I think that will produce a genuinely more benign investment sector.
Okay, well, thank you very much, both. That concludes this episode. Thank you for listening to Taxing Lyrical. We hope you enjoyed the podcast.
Thank you.
Thank you.
Thank you for listening to the Evershed Sutherland Legal Insights podcast.